Hi everyone, welcome to our video on the 1992 financial crisis in the Indian market. In this video, we'll be taking a deep dive into what happened during this crisis, why it happened, and what its impacts were on the Indian economy. Chapter 1, Background. To understand the 1992 financial crisis, we need to first look at the Indian economy leading up to it. In the 1980s, India faced a balance of payments crisis due to a large trade deficit and declining foreign exchange reserves. To address this, the Indian government implemented a series of economic reforms, including liberalizing the economy and opening it up to foreign investment. These reforms helped to stabilize the economy, but they also created new challenges and vulnerabilities. Chapter 2, The Build-up to the Crisis. In the late 1980s and early 1990s, India's economy grew rapidly, driven by increased foreign investment, a booming stock market, and a growing middle class. However, this growth was accompanied by rising inflation, a widening trade deficit, and mounting external debt. To finance its imports and debt repayments, India relied heavily on short-term borrowing from foreign investors. Chapter 3, The Trigger. The trigger for the 1992 financial crisis was the announcement by the Indian government in June of that year that it was devaluing the rupee and liberalizing foreign exchange controls. This move led to a sharp drop in the value of the rupee and a surge in capital outflows, as foreign investors began to pull their money out of India. Chapter 4, The Response. The Indian government responded to the crisis by taking a series of measures to shore up the economy and restore investor confidence. These measures included raising interest rates, tightening fiscal policy, and negotiating a loan from the International Monetary Fund (IMF). Chapter 5, The Impacts. The 1992 financial crisis had significant impacts on the Indian economy. The sharp drop in the value of the rupee led to inflation and higher import costs, while the surge in capital outflows created a liquidity crisis in the financial sector. Many Indian businesses, particularly those that relied on foreign investment, were forced to close or downsize. Chapter 6, Lessons Learned. The 1992 financial crisis was a wake-up call for the Indian government and the business community. It highlighted the risks of over-reliance on short-term foreign borrowing and the importance of maintaining macroeconomic stability. It also showed the need for a more robust regulatory framework to monitor and manage financial risks. Chapter 7, Subsequent Reforms. Following the 1992 financial crisis, India continued to implement economic reforms to make its economy more competitive and resilient. These reforms included further liberalization of the economy, the introduction of a goods and services tax, and improvements to the regulatory framework. Chapter 8, Current State of the Indian Economy. Today, India is one of the fastest-growing major economies in the world. Its economy has diversified and become more resilient, with a growing focus on technology and innovation. However, India still faces a range of economic challenges, including high levels of inequality, a large informal sector, and a growing non-performing asset problem in the banking sector. Chapter 9, Conclusion. That's all for today's video on the 1992 financial crisis in the Indian market. We hope you found it informative and useful. If you have any comments or questions, please leave them in the comments section below. And don't forget to subscribe to our channel for more videos on economics and finance. Thanks for watching.